Hello, colleagues. Welcome to Math Institute. So we are an online platform that simplifies university for you. We try to engage our students in most of the computational courses. So if you want to watch more videos, please hit the like and subscription button on our YouTube channel. And you can visit us on our website, www.mathyatinstitute.com. Alright, so today we are going to look at a question in financial reporting. I had some requests to help out with a consolidation question. So today we are going to look at that question. Okay, and students, it's fascinating to learn that students actually find financial reporting and the aspect of consolidation as a challenging topic, but I'll try to simplify it as much as possible so that we can all grasp the contents. I will split this video in two. So this will be part one, and where I will leave it from is where I will begin in another video. Okay, I just needed to make that one clear. Okay, consolidating the statement of financial position, exam question. It was actually an exam question, and it's a group consolidation. So remember, I'm just answering a question. It's not a lecture of the topic itself. It's just trying to answer a question. So I'll limit my explanation to the question and not to the topic at large. I will do a topic. The topic, if you, my viewers, want me to actually expound over the topic. Alright, so let's dive right into it. Let's get it started. Okay, so we have Alpha Co. purchased 1,450,000 ordinary shares in Beta Co. in 20x0 when the general reserves of Beta stood at 400,000 and there were no retained earnings. The statement of financial position of the two companies as at 31st December 20x4 are set out below. Okay, so this is the financial statement or the financial position of the group. So we have Alpha and Beta, and most of the times actually we find the parent company almost always on the starting on the first row, and is it column, on the first column, and the subsidiary or an associate or anything else comes after the parent. So even before we can go into the intricacies of the question, we know that Alpha here is the parent, because it will always be the starting one. Okay, if anybody has seen a question where the parent is on the right and the one starting is the Beta, I stand to be corrected. Okay, sure. So this is our financial position. And it goes down to that total equity and all that. We have our long-term current liabilities, total non-current liabilities. What am I saying? Okay, sure. So let's look at the notes. The first note is saying, at the end of the reporting period, the current account of Alpha with Beta was agreed at 23,000 owed by Beta. So okay, so this is an intra-group transaction. Okay, I hope we have seen it. So let's note, if we want, we can write that as intra group so that we don't forget. So we are seeing alpha and beta trading amongst each other. And apparently there is some money owed or goods that were not paid for. So that is very important when we go to our workings. This account is included in the appropriate receivables and trade payables payable balances shown above. There has been no impairment of goodwill since the date of acquisition. Okay, so here no impairment, which makes our question a little bit even easier. It is the group's policy to value the non-controlling interest at its appropriate share of the fair value of the subsidiary's net asset. So here we are considering our net asset, the net asset of the subsidiary. So that would be our basis of calculating the non-controlling interest share or proportionate share. All right. Another note. Oh, okay. We're direct into the question. So this one is a straightforward question. Prepare a consolidated statement of financial position for the alpha beta group. Okay. All right. Then the second part is show the alterations necessary to the group statement of financial position if the intragroup balance owed by beta to alpha represented an invoice for goods sold by alpha to beta at a markup of 15% on cost and still unsold by the end of the reporting period. Okay, so if you notice that this one is very important, and we usually it's supposed to be in our workings, and in like we need to kind of embed it in the financial statement. But look, it has been put as B. So because we are supposed to prepare the financial statements first, to consolidate first, so we will ignore this part as though we don't know that we had some unrealized profit and all those stuff. Okay, so we are just going to consolidate, then we will come back to it as B, and we'll see how we're going to deal with it. All right. Into the workings. So as we know, we cannot consolidate before we do the workings. So we need to establish workings, then we consolidate. So our first working is always group structure. So working 1. Group structure. Now we are being told that Alpha Co purchased 1,450,000 ordinary shares. So when we are finding the group structure, so here we are just seeing that there is only one company involved as a subsidiary. So it's a vertical, but of just one subsidiary. So if we have, so we're going to denote alpha by A, then beta by B. Okay, to find the percentage of the parent in the subsidiary, which is B, we need to divide how much of the shares we bought divided by the total shares of that subsidiary. So we bought one, so we are going to remember these zeros, as you can see here, the 3 zeros are put up, so we will not consider these zeros. So we are going to say 1,450 were the shares, and that always comes up. So 1,450 divided by the total shares of the company. So if we go to the column of the subsidiary down to share capital, we are being told that we have this is the money. Remember, these are monies, these are shares. So 1,000 US dollars. But how much is each share valued at? It's valued at 50 cents. So if it's valued at 50 cents, what we are going to do is we are going to divide 1000 divided by 0.5 in order to find the total number of shares. So that would be 2000, right? So we're going to divide by 2000 and multiply by 100 to get the percentage. Okay. We all have calculators. Let's try to get that one. Okay, so that will be 72.5%. Okay, so that is our the parents' share in the subsidiary. So if we add the non-controlling interest, we need to have a total of 100. So basically 100 minus 72.5 gives us 27.5. So that is the value of our NCI. Alright, so this is our group structure. That is our group structure. We can go to working 2. Working 2. Okay, so working 2. Initially, we are supposed to calculate goodwill. But usually for us to calculate goodwill, we need the net assets of the company. So instead of doing it directly, we are going to simplify it by putting the working of net asset list. So we're going to calculate net assets alone, as standalone. Then that's when we're going to go to goodwill. Okay, so net assets. So net assets, we're supposed to put the value both at acquisition and at reporting. Okay, remember these this is US dollar. We are putting these zeros. So when we are talking about net assets, let's go to the equity side. So equity section will give us our net assets. So basically we are going to get everything here. Everything under equity comprises the net assets of the company. Okay, so let's dive into it. So we have share capital. So share capital at reporting, and that we haven't been told that there were any increase or dispatch of shares. So we're going to get that as it is, 1000. Well, remember we're getting for the subsidiary. 1000, or even this side. General reserves, we have 800. This is at reporting. So 800 at reporting. What about at acquisition? We have 400. Okay, that is our reserves. Okay, what about retained earnings? Retained earnings, it was 0 at acquisition. What about at reporting? At reporting, it is where is it? It is 100. Okay, so let's sum up these. We know that is 1000 plus 400 is 14. Okay, and 1000 plus this, it would be 1819. Okay, so the difference between the post and the pre, or the acquisition and the reporting, gives us the post acquisition profit. And we can see that the post acquisition profit here, the difference is 500. So that becomes our post acquisition profit. Okay, so basically this is I think the lectures will be 3 now.